As we enter 2025, the retail landscape continues to evolve dramatically, with several once mighty giants teetering on the brink of bankruptcy. The combination of changing consumer habits, the aftermath of the pandemic, and the relentless rise of e-commerce has created a perfect storm that's pushing these established retailers to their limits. Today, we'll examine 15 major retail chains that are facing serious financial difficulties and might not survive the year. Let's start with Bed Bath & Beyond's successor, Beyond Inc. After the original company's bankruptcy in 2023, the digital-first version that emerged hasn't found its footing. Despite attempts to reinvent itself as an online retailer, mounting debt and declining sales have put it back in a precarious position. The company's stock has plummeted 85% since its restructuring, and analysts predict they'll run out of operating capital by mid-2025. Next up is Tuesday Morning, which has already filed for bankruptcy twice in recent years. Their third attempt at resurrection isn't going well. The discount home goods retailer has closed hundreds of stores and is struggling to maintain inventory levels that would attract customers. Their remaining 200 locations are seeing double-digit sales declines, and suppliers are increasingly reluctant to work with them. Party City, despite emerging from bankruptcy in 2023, hasn't managed to address its fundamental problems. The party supplies retailer faces intense competition from dollar stores and online retailers while carrying nearly $1.2 billion in debt. Their attempt to pivot to online sales has been hampered by poor execution and declining margins. JCPenney, which narrowly avoided liquidation in 2020, is once again showing signs of serious trouble. The department store chain has failed to attract younger shoppers, and its partnership with Sephora ended when the beauty retailer moved to Kohl's. Their remaining stores are experiencing declining foot traffic, and their online presence remains weak compared to competitors. Fifth on our list is Rite Aid, which filed for bankruptcy in late 2023, but hasn't shown signs of successful reorganization. The pharmacy chain continues to lose market share to CVS and Walgreens, while facing numerous lawsuits related to opioid prescriptions. Their debt load remains unsustainable, and many analysts predict a complete liquidation by year's end. The once prestigious Neiman Marcus is facing its second potential bankruptcy in 5 years. Luxury retail has become increasingly competitive, with online platforms like Farfetch and Net-a-Porter capturing more market share. The company's debt restructuring in 2020 wasn't enough to solve its fundamental problems, and sales continue to decline. Seventh on our list is Jo-Ann Fabrics and Crafts. The craft retailer has been hit hard by changing hobbies and competition from online craft suppliers. Their debt load has become increasingly unsustainable, and they've already begun closing stores across the country. Their attempts to modernize their business model have been too little, too late. GameStop, despite its meme stock fame in 2021, is facing serious financial challenges. The gaming industry's shift to digital downloads has continued to erode their core business, and their attempt to pivot to e-commerce hasn't generated sufficient revenue. Their crypto and NFT marketplace initiatives have largely failed, leaving them without a clear path forward. Ninth is Express, which has struggled to maintain relevance in the fast fashion market. The clothing retailer has seen its market share eroded by online competitors like Shein and ASOS. Their attempt to appeal to younger shoppers through their Up West brand hasn't generated enough traction to offset losses in their core business. Big Lots rounds out our top 10. The discount retailer has been caught in an uncomfortable middle ground between dollar stores and more upscale retailers. Their attempt to offer furniture and home goods hasn't distinguished them enough from competitors, and their debt load has become increasingly problematic. The 11th retailer facing potential bankruptcy is Petco. Despite the pet industry's overall growth, the company has struggled with increasing competition from online retailers and specialty stores. Their debt from their 2021 IPO has become a significant burden as sales growth has slowed. Number 12 is Five Below, which has seen its business model challenged by inflation and changing consumer preferences. The dollar store concept has become less viable as manufacturing and shipping costs have increased, and their attempts to sell higher-priced items have confused their brand identity. The 13th retailer in trouble is Michaels Stores. Like Jo-Ann Fabrics, they've been hit hard by changing hobby trends and online competition. Their private equity ownership has left them with significant debt, and their digital transformation efforts haven't produced the desired results. Academy Sports Plus Outdoors comes in at number 14. The sporting goods retailer has faced intense competition from Dick's Sporting Goods and online retailers. Their concentration in southern states has left them vulnerable to regional economic downturns, and their debt load has become increasingly concerning. Finally, we have Dillard's. The department store chain has struggled to maintain relevance in an increasingly digital retail landscape. Their concentration in secondary markets and reliance on traditional department store merchandise has left them vulnerable to changing consumer preferences. These retailers' struggles highlight several common themes in the current retail apocalypse. First, excessive debt loads, often from private equity buyouts or aggressive expansion plans, have left them with little room to maneuver in challenging times. Second, many have failed to effectively transition to digital commerce, losing ground to more agile competitors. Third, changing consumer preferences and shopping habits have made many traditional retail models obsolete. The impact of these potential bankruptcies extends far beyond the companies themselves. Shopping centers and malls that rely on these retailers as anchor tenants could face serious challenges. Thousands of workers could lose their jobs, and suppliers could face significant losses. Local communities could lose tax revenue and see increased vacant commercial space. However, it's important to note that bankruptcy doesn't always mean the end of a business. Some of these retailers might emerge from bankruptcy protection stronger and more focused. Others might be acquired by stronger competitors or investment firms that see value in their brands or real estate. For consumers, these potential bankruptcies could mean both opportunities and challenges. While liquidation sales might offer short-term deals, the long-term reduction in retail options could lead to less competition and potentially higher prices. The loss of familiar brands and local shopping options could also impact shopping convenience for many consumers. As we move through 2025, it will be crucial to watch how these situations develop. The retail landscape continues to evolve, and while some traditional retailers will undoubtedly fail, others will adapt and survive. The key lesson for all retailers is the importance of maintaining financial flexibility while continuously adapting to changing consumer preferences and shopping habits.